Ladies and gentlemen, good day and welcome to Mech Projects Ltd. Q1FY27 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Julie Baviskar from Ashika Institutional Equities. Thank you, and over to you, Ms. Baviskar.
Thank you. Good afternoon, and very warm welcome to everyone. On behalf of Ashika Institutional Equities, I welcome you all to Mech Projects Ltd. Q1FY27 earnings conference call. Today, we have with us management represented by Mr. Rohit Sajja, Executive Director, Mr. N. Nani Arvind, Chief Financial Officer, and Mr. S.K. Ramaiah, Director, Business Development. We thank the Mech Projects for giving us the opportunity to host the call, and we will now like to hand over the floor to the management for their opening remarks, post which we will open the floor for Q&A. Thanks, and over to you, sir.
Good evening, everyone. I am Nani Arvind, CFO of the company. I would like to extend a warm welcome to all of you joining us today for our Q1 FY27 earnings call. Thank you for taking the time to participate in this discussion. As we begin financial year 2027, the first quarter reflected the continued strength of our growth trajectory, with improved performance across most of our core business verticals, except ETC business. Our results reflect the strength of our integrated business model, disciplined execution capabilities, and continued focus on operational excellence. For Q1 FY27, the company recorded total revenue of Rs 1,632 crore, reflecting 26% growth over the same quarter last year. The growth was driven by sustained execution across our core verticals, along with the ramp-up of operations in civil infrastructure, industrial EPC, O&M, and international projects. EBITDA for the quarter was 176 crore at a 10.8% margin, representing a 3% decline year-on-year. The margin was lower compared to the same quarter last year, primarily due to higher material and execution costs arising from the ongoing Middle East conflict, increase in royalty costs in the KRPM project following the government orders on royalty sharing for seized quantities, lower margins in the KBP mining business, primarily due to higher overburden removal costs from the opening new seams during Q1. Production from these seams is expected to ramp up in the coming quarters, improving margins. Lower other income during the current quarter. However, our standalone business noted a 11.3% EBITDA margin compared to 10.2% in the same quarter last year. Profit after tax stood at 89 crore, reflecting 11% increase over Q1 FY26. Profit after tax after minority interest stood at 80 crore compared with 53 crore in Q1 FY26, reflecting a 53% increase over Q1 FY26. This has helped to take the EPS to 25.23 rupees compared to 16.61 in the corresponding quarter of financial year 26. The management is confident of maintaining its full year target in terms of execution, order book, and margin profile. Coming to the revenue mix, the quarter continued to reflect a well-diversified contribution across our business segments. The O&M business continued its steady growth, contributing 431 crore, an 8% increase year-on-year, supported by new order inflows during the year. The civil segment, including roads, railways, and water distribution projects, contributed 796 crore, registering a 28% year-on-year growth. The industrial construction business contributed 217 crore, down by 13% year-on-year, which was offset by the industrial EPC business, which contributed 96 crore. The mining business showed strong positive trend with a revenue of 84 crore, representing 223% year-on-year growth, supported by the commencement and the ramp-up of revenue from the KBP mine from November 2025 onwards. Now coming to the revenue mix for Q1 FY27, the geographical revenue mix comprised 96% domestic and 4% international revenues. Sector-wise, the power segment contributed 54% of the revenue, while non-power segment contributed the remaining 46%. From the order inflow, the company secured orders worth approximately 1,864 crore during Q1 FY27 against our annual target of rupees 12,000 crore, representing approximately 15.5% of the annual target. Order inflows during the quarter remained well diversified across industrial construction, civil infrastructure and O&M. Among the key award wins during the quarter include O&M of Mumbai Monorail. This project also marks our entry into the highly technical urban mobility space. Our total order backlog including MDO projects stands approximately 55,398 crore. Excluding MDO orders, the executable order book stands at around 16,229 crore. This provides us with strong multi-year revenue visibility across industrial construction, civil engineering, EPC and O&M business. We continue to see the strong order pipeline across thermal power, both construction and maintenance, BOP systems and civil infrastructure. So in summary, we are pleased with the progress achieved during Q1 and FY27. Our diversified order book, strong execution capabilities and strategic focus on high value projects continue to position the company for sustained long-term growth. Our key priorities remain to improve execution in line with our planned trajectory, sustain and improve our margin profile through a higher contribution from O&M, mining and other relatively higher margin business, and further improve cash conversion and working capital efficiency with continued focus on collections, milestone certifications and mobilization advances. With a strong order pipeline and execution momentum across our business, we remain confident of delivering on our growth objective and creating long-term value for all our stakeholders. With this, I now request Mr. Ramaya Garu to share the key business developments and the outlook for the upcoming period.
Yeah, thank you, Arvind. Kodan Ramaya here. I think in continuation to what Arvind has said is that there is a improvement in the total order backlog from the commit at the end of the last year, 15,898 crores beginning, and now it is 16,228 crores, a plus 2%. Of course, major order improvement has come up in the civil segment with about 4.4% add-on backlog. And then O&M substantially more growth is there with the first quarter order for 781 crores, and that has boosted the order backlog by 11.8% to 3,322 crores. That is a very positive sign. And of course, EPC segment, electrical, these segments, based on the revenue, it has to come down. And then the ETC business also, there is a, because a lot of opportunities, I will explain it in later. Now, that is on the segment wise, and the domestic market continues to play a major role of 98.7% of the order backlog and order opportunities of booking, and international is 1.3%. And then the power sector continues to play a business in view of the huge capacities and huge investments coming into play, and the being the expertise we are having it, a lot of focus is up there from the organization. Also, non-power is about 26.4%. This is the overall order position. Now, coming to the opportunities, what we have done in the beginning when we started, we mapped an opportunity size of 70 to 75,000 crores on a broad basis in various segments of the different SBUs in power, non-power, installation, O&M, civil, then in the infrastructure, etc. Now, coming to the quarter-wise, more focus is there, and that has to be seen based on the real opportunities, what we are going to get it. As on today, about 20,500 crores of opportunities we are mapping on the power sector alone. That is mainly for the installation business, for the civil work, structural work, and the balance of plant packages. And then on the infrastructure side, about 8,500 crores. Therefore, over the quarter-wise, when we progress and all, the more opportunities will come up. This is based on the tendering opportunities and the tender notices issued. That is where we have to focus it. And therefore, from the overall perspective, when I say in the power sector, the overall scenario is like this. We have been tracking about 58,000 megawatts of ordering which has been done in the main players like BHL and L&T for the last 3 years. That is based on our interest, where we have to focus it. Of course, the capacities can be different based on the overall market. Specific projects we are tracking it. And based on this, BHL has got the bulk of the orders, about 2.41 lakh crores, and then L&T is capturing a lot of orders, 42,523 crores. And recently, JSW has entered the fray with the 2 major plants coming up, one at Salboni and another Assam, 4 units each, 2,200 megawatt, and they are going to invest substantially between around 30,000 crores there in both the cases. Now, if you look at the overall scenario of the various players, apart from the in the state sector, central sector, and then the private sector is taking the lead. Adani is planning to jack up their capacities from 18,330 megawatt to 42,000 megawatts in another 5-6 years. And then this one, NTPC is planning to improve their capacity in the coal-based plant from 67 gigawatts to 91,000 megawatts. And JSW, which has come recently, present capacity is 5658. They have got ambitious plan to achieve a capacity of 30,000 megawatts in the next 5 to 7 years. Therefore, there are other players also, the state sector like Singareni SCCL, JSCCL, then Chhattisgarh Generation Company, then one private player, Moser Bayer Power, and then NLC, the central government. All of them, there is a add-on capacity, and DVC also, HPGCL already have taken action. Therefore, what we have done in this is that we have mapped an opportunity which is available in the next, say, 1 or 2 years, about 60,000 crores. As on today, taking into account what has been gone forward in terms of ordering and etc., the balance ordering which has to be done for what type of work in the site construction work is tendering. Balance is, BHL about 11,000 megawatts. And then the Adani about 11,200 megawatt. That will come to 22,000 megawatt. And then JSW is planning with 6,400 megawatt. That should together come out 26,000, something like that. Now with that, we are expecting immediate opportunity of 25 to 30,000 crores. And then the coming year also it can add up. And that is where the overall focus of the company is there, because of the strength we have developed it, and better to capture, going to the opportunities where it is there. And private sector business opportunities also better for us, because both Adani and JSW, their focus is on deliverables, and then they have got a preference for companies like Power Mech because of our delivery management. And recently we have taken a major job from JSW also for their Salboni job, 850 crores for the civil and structural. And then Adani will continue to pursue with all the ongoing projects of their whatever is the new ordering. I said about 11,000 megawatts which they have to complete it. And therefore, from that perspective, this will be continued to be the focus. And then the other aspect is the O&M side. O&M is, we have seen 781 crores we have taken in the first quarter, and then the order backlog also has gone up by more than 11%. And compared to last year, the 2,972 crores is now 3,322 crores. Therefore, one of the positive things can be how much is the capacity added in the new plants, particularly the private sector, because they will be more interested, like Adani, Vedanta Group, JSW, JSPL and all. And we are working in all of them. And then, that opportunity about, it is expected, if the government's plan is to add up capacity from present 228 gigawatts to 291 gigawatts by 2032, adding 61 gigawatts, and then it will go up to 321 gigawatt. Therefore, average addition of capacity is 8 to 10,000 megawatts per year. Therefore, that should show an opportunity of 800 to 1,000 crores in O&M. Therefore, and O&M being a renewable base type of segment, and the existing contracts will be added, will be renewed, and the new contracts will add, which will lead to the better growth and all. And the other areas which we can positively look at is in terms of the non-power sector, and then the new investments which are coming in the mining side. For example, NMDC is planning an investment of 70,000 crores. and certain tenders have come. We have participated in one tender earlier. We were L1, but they had a issue on the pricing. It has been retendered. We are again participating in that. And presently they are calling three tenders. One tender we are trying to obtain, another two tenders will follow up. And then there is also a lot of investments will come up in the steel sector also that we have to see in the all the players. Particularly the JSW is planning a huge capacity expansion in Paradeep, and then their existing plants, and also putting a greenfield plant in Maharashtra. And then ArcelorMittal is coming with a huge plant in near Vizag. That is around 10 lakh, huge capacity, about 1.5 lakh crores, about 10 million ton capacity plant. And then others are also. Therefore, that is an opportunity which we have to see to expand our business. And then mining side, I said about the NMDC, the new plants which are coming up for mining side on a build, operate, transfer basis. That is an opportunity. Now, based on the experience what we are gaining in this our MDO contracts, we can apply our expertise and all to see that how we can go into that. And then the other infrastructure jobs in roads, railways, as we know, the government's continued investment is there, and need-based opportunities we are capturing it in both roads and railways. But in railways, the maintenance depot shops, we are now getting specialized. We are working in a couple of projects there, and new projects when it comes, we will definitely participate in that, apart from the new railway lines. And then the EPC jobs in both in railways, and then the road sector. On the international sector, the present focus is, of course, the disturbed conditions in the Middle East. Last year we have seen it is mostly on the O&M side, which is quite profitable. We have taken long-term contracts in Nigeria, the Dangote job, and some more jobs we have taken on the multiple jobs of maintenance jobs, on nearly 300 crores. And that is in UAE and then GCC countries and all. That focus will continue to be there in the present year also. Hoping the situation will improve based on the conflict, which is the ongoing conflict will end. With this, what I can say is that mapping of the opportunities, we continue to see how to achieve this 10 to 12,000 crores of order booking for the current year based on the opportunities what we are having and the new opportunities which are expected to come. Thank you.
Shall we open the line for questions?
Yes.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, I'm audible.
Yes, Deepak.
Yes.
Yeah, thank you very much, sir, for this opportunity. So just first up, wanted to understand on the margin front. I mean, you cited few reasons, right? I mean, the overheads removal cost and the royalty as well as the raw material cost. So how is the scenario right now? I mean, how should one look at overall annual the EBITDA margins given the current scenario?
Yeah. See, the increase in royalty last year, when you are comparing with the last year quarter presentation, there is exceptional revenue recognized in Q1FY26. Seasonal quantity where we generated more revenue, and the current subsequently the government issued an order and they reduced the royalty rates. And this time KBP mining just started the production from November onwards, and initially we did around 1.6 million tons of execution during the last till March, and the current year we are targeting around 3 million tons. We started the new seams that where initially OB removal is a higher side, where we just started the seams, and the corresponding coal production will start from the subsequent quarter. Overall, the stripping ratio is within the agreed quantity ratio only, but one quarter will have a higher OB cost and lower coal production. Subsequent quarters will cover that. Overall, for the year, we will maintain the same EBITDA committed margins of 15 to 16% in KBP mine. And moreover, lower other income. See, we have a QAP funds in the standalone level, and we are using that QAP funds for the washery construction. and we have almost completed the QAP proceeds, and the FDs which are lying in with us in our bank, the interest income we generated because of that also, the other income has a higher side, 3 to 4 crore higher side as in the earlier periods. Now we completed that, and we are now not generating any revenue from the, we are generating revenue only on the FDs of margin money FDs only. That is also one of the reasons. And overall, we projected guidance is 12.5% margin, which we committed during the current year. We are sure about getting this margin profile, and we got a lot of new orders we received during the last year on the O&M and civil infra projects where we got the good margins in those projects. We will sure that we'll generate this EBITDA margin in the current year.
Okay. Yeah, that was very helpful, sir. And then secondly, on MDO, so what sort of execution we are targeting this year and next year from MDO?
Hi Deepak, Rohit here. So with regards to the MDO, we plan to do 3 million tons in our first mine, which is KBP, and perhaps in the second mine, the washery is about to get commissioned. We expect to do the hot commissioning by November, December. That's when we are going to achieve the full feed of the resource that we are going to produce here. So both the mines together, we expect to do 500 crores by the end of this year. So 3 million tons in the first mine. Second mine will do close to 1.2 to 1.3 million tons, because it's going to start ramping up once we have the full feed available after the washery gets commissioned.
Correct. And what about FY28?
FY28, 1,100 crores to 1,200 crores. So there's going to be a significant ramp up, because once the washery is commissioned, we anticipate to achieve peak rated capacity in the sale mine, which is 3.5 to 4, because there is 500 half million tons of JAMA coal that we also have to produce. So depending on how much JAMA that comes in seams, so 3.5 to 4 is ideally what we should look at there after the washery is constructed. And KBP, the first mine with CCL, this year we'll do 3, next year we will ramp it up to 4 to 4.2 million tons, Deepak.
Okay, I got it. And in terms of margin, I mean, given your higher share of revenue coming from MDO, so what does it mean for the overall margins? I mean, how much benefit overall at the company level this increased MDO revenue can bring?
Yeah, so I think FY28 we should be able to see a net margin of 21 to 23%, both the MDOs together. And this margin profile is going to continue over the life of the mine with few ups and downs. Whenever we have to do some capex reinvesting at the end of 7th year, at the end of 13th year, there's a conveyor that we have to construct. But otherwise, this is the averaged out margin profile that we'll see.
Okay. So next year at 1100, 1200, 21-23% EBITDA margin in MDO, this is an achievable task.
No, this is when we reach the peak rate capacity only. This is the expected 20-21% blended weighted average.
Okay.
So next year 28, we still won't, one of the mines we still won't reach peak rated capacity. So probably from 29 you can see these margins. So next year will be around again 15 to 17 range, and then it will ramp up to 21 to 23.
Next year would be 15 to 17, and FY29 maybe 21-23% is from MDO one can.
Yes.
Okay. And just one last thing on the opportunity size that you mentioned, around 25-30,000 crores. So is that your bidding? Is this the amount that we look to bid? I mean, in going forward.
Yeah, I think you are correct. See, initially we make an estimate based on the opportunity, that is based on our internal assessment. Once the tenders comes, we try to make a more accurate estimates of that, based on how the customer asks for the scope and qualification and other things. Therefore, that is the sizing of the opportunity based on the real opportunity has come up. That will develop from quarter to quarter. As on today, I said you about 20,500 in the power sector, and then 8,000 some crores in the non-power sector, infrastructure and other areas. And every quarter we will update that. And based on the tenders won and tenders lost, and then we have re-update the new opportunities as it comes, and also see where all we can penetrate the new sectors of the business.
Correct. And this 12,000 crores of order inflow for this year, we are looking from this pool of 25 to 30,000 crores, right?
In this, there are some specific opportunities, one in the power sector, and then we are also mapping another balance of plant package. 2-3 opportunities are coming up. We are working closely on that. And then O&M, we expect the growth will be there because of the additional capacities that are getting added and the new power plants getting commissioned. And then particularly we have got a very solid relationship with Adani based on our performance and our record of working. And there are a lot of new plants which are getting added into their capacity addition plan, like Pirpanti is there, Assam is there, and then new other many projects, and then JSW also has a 6,400 megawatt project identified. We are hopeful, the power sector business also should go up in terms of our installation business as well as the civil and structural business. And then with BHL, we will be targeting the balance of plant packages, and then O&M with all the private sectors.
Okay.
And also, Deepak, just to add to what Ramaya sir had just said, so typically in the power sector, our strike, to answer your 25,000, 30,000 crore question, in the power sector, our success rate is around 60 to 65%. So most of the bids we participate in, we anticipate or we expect to win based on historical data and the way we are progressing here. So that's why we cap this at 30 to 35,000 crores in terms of the number of projects we bid for and arrive at this number of 12,000. Just wanted to give you the clarity.
Yeah. Got it, sir. And that's quite helpful. That would be from my side. Wish you all the best.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Madhu Agarwal with Agarwal Family Office. Please go ahead.
I have a quick clarification on the expected revenue from mining across KBP and Thasra. Are we revising downwards from the 600 crore? I think last quarter we had said we do 350 from KBP and 150 from Thasra. Are we now revising that downward to 500 across both the mines?
No, both together is 500, ma'am. So that's what we told. 350 plus 150 from Thasra together 500 crores. There is no down.
Sorry, my apologies. I've just gotten my math wrong. My apologies. That's fine. Thank you.
Thank you. Next question comes from the line of Bhagwat with Prosperity Wealth Management Private Limited. Please go ahead.
Thank you for the opportunity. Could you please give us more details on the KRBM project, specifically the expected revenue from the project and EBITDA margin from this particular project after factoring in the revised royalty structure?
So the nature of work of KRB means that we have to ensure that the entire corporations which they have allotted the mining activity, we have to ensure that there is no leakage of royalty, and we have to establish our check post and all the transport vehicles, so people who are verifying the royalty, and any unpaid royalty transportation vehicle, then we used to collect the seized quantity and we will collect double the penalty. So the royalty indirectly, we get it 2 times the royalty value. The subsequently government during mid of the year, last year, they 50% of that royalty penalty collected, the government is taking that 50% value and 50% only is passing to the company. So that last year it was a huge seized quantity which we recognized in our revenue. Subsequently, because of these heavy penalties, the clients are not doing that much of avoidance of the penalty is not there now, but they reduce the seized quantity value during the current year because of this double payment penalties and all. That is one issue, and another is that they increase the royalty rate to 10 rupees per metric ton as an additional royalty payment, and some MITF charges which they are collecting 5% of the royalty value. These are all increased costs which we have incurred during the last current year.
So, what is the project size, if you could quantify that number-wise?
The revenue we have, last year we did around 700 crore. This year also we will touch the 750 crore from the KRBF.
Okay. And what is the specific EBITDA margin for this project?
See, earlier it was average. Last year we did around 14% EBITDA. This year, first quarter, it just came down to 10% level.
10% from the earlier 14%, right?
So from 14 it has come
From
down
14
to
to come down to 10% because of this additional royalty clause.
14 was annual.
Okay, and
Q1, and we expect to maintain 10 to 11% until the end of the year for the remaining quarters as well.
Okay. Thank you for the answer.
Thank you.
Thank you. Next question comes from the line of Mahesh Patil with ICICI Securities. Please go ahead.
Yeah, hi sir. Just a clarification, in the base quarter, Q1FY26, we had booked this additional royalty payment, right? I think penalty was there of around 2.8 billion.
In 2014, this was there. So the Q1, there is no sharing of royalties. 51 crore we recognized this quantity revenue during the Q1 of last year.
Q1 of last year, right? So there was this 0.5 billion of EBITDA level impact because of that. Is that correct?
Yes.
Okay. So is this the same project that we're talking about now, where the royalties, the government has come up with this decision, or is it different?
No, one is that seized quantity, the evidences, the violations have reduced now. The quantity is also reduced. Earlier, we just started 1 year before that. Last year, because of this heavy penalty, the people are paying the royalties without any much of that. Seized quantity is coming down now. Not much of the seized quantity, and subsequently they have allotted some of the private patas and the level judging activities to the new players. This penalty clause is majorly applicable. This is only minor amount which we are getting this seized quantity during the current year.
Okay. But in this current quarter, is there some amount that is comparable to last year? Is there any penalty amount booked in this quarter?
Around 30 crore seized quantity only we have recognized, but that is in terms of value as compared to the previous, it is very less.
Okay, so no one-off as such in this quarter, right?
Yes.
Okay. And sir, in terms of margins, I think you have also mentioned some impact from the cost escalation due to the Iran conflict, right? So if you can just quantify it, and just wanted to understand, don't we have a escalation clause for this in our contract?
So the mining side, in the standalone level, our EBITDA margin has improved compared to the last year because of the new orders which we received, and we managed the costs in the standalone level. At Concall level, our major consumption is the diesel, where diesel rates have increased, and that has impact on the profitability.
Okay, got it. And sir, among the 2 months, I think we have done 84 CR of revenue from mining sector, right? So this quarter. Can we get a breakup of this?
The breakup. KBP we did around 57.54 crores. In Kasara, 26.34 crores.
Okay, thank you so much. Sir, sorry, one last question. Hello. Yeah. Sir, see, despite the margins in Q1, we are still confident about achieving our 7.5% guidance. So, what gives us the confidence? Is it just the mining production ramp up, or is it something that we are so confident of achieving this guidance?
So the KBP we are not targeting to, even though as per the agreement is 1.5 million, but the client is ready to take it up to 3 million tons during the current year. And conservatively, we projected 350 crore of revenue based on the production average basis, but we can do more than that also. So conservatively, we are projecting at 350, and we are confident of getting this 500 crore revenue.
Okay. So that is the key margin driver that will lead to our guided level, right?
By Q4, our washery also will be ready, and we are expecting that at least 1 or 2 months production will be there in the Tasra also. Overall, both together, we will target around 500 crore turnover.
Okay, sir. Got it. Thank you.
Thank you. Next question comes from the line of Mudit Bhandari with IIFL Capital. Please go ahead.
Hi, sir. Thank you for the question. Sir, previously we had stated that, and in this call also, that there will be many projects from NTPC and Adani coming up, like Lara, Yamunanagar, Raigad, Mahan, or Mirzapur. So I think we got Singareni and Mirzapur. So can you tell what about various projects? In the last, let's say, 1 year, how many projects were awarded and how many we got, in terms of whether they have been delayed from the awarding or any other scope of any other player getting any other scope of work. So what's the history been, and coming ahead, let's say within the next 1 year, which major projects are we targeting?
So what I told you earlier, I will tell in terms of megawatt. Tendering has been out of the whatever tracking I said about 58,000 megawatts. Tendering which has been completed by BHL and Adani comes to around nearly 28 to 30,000 megawatts out of 58,000. The ongoing tenders or opportunities which we are tracking as on today is about 24,000 megawatts. That is where the opportunity comes to. What I said earlier, the immediate opportunity is about 20,500 crores. That is as on today. But there are about dozen projects which are in the pipeline for tendering from BHL, then Adani, JSW, and then expected tenders to come from L&T also. And to some extent, BHL's tendering has been delayed for a variety of reasons, and there is a packaging issues also. Unlike a vertical composite package, integrated package which Adani gives it, in terms of end-to-end construction solution, which fits into our execution philosophy, we prefer to work there where the size of the package will be more. And then, there is additional advantage of doing that work along with undertaking the civil and structural work. Therefore, most of the projects what we have done in Mahan, then, Mirzapur, and now Raipur, and now what is expected in JSP or JSW also, we are planning to do both civil, structural and mechanical work. Therefore, from that way, we are tracking closely with both Adani and JSW, and to see how it develops to BHL. That's where that opportunity has been mapped. And then we continue to be more bullish on the Adani and JSW jobs.
Got it, sir. I was looking for if any projects that we are targeting, but not issues. And
there are projects which we have already, for example, in the case of Adani, Pirpati is there, then Assam project is there. In the case of JSW, there is Salboni is there, another Assam project is there. Then some more projects have to develop for them, and that is expected to come for tendering. And BHL, yes, because of the packaging philosophy and all, we have to take a call on that. And then on the balance of plant packages, there are some specific projects which are targeting. Durgapur is there as on today. Therefore, these are all very specific projects on which work is going on for tendering.
Got it, sir. Thank you so much. And when we say we have been impacted because of raw material price increase, so what specific raw material are we looking at? Is it basically the commodity or anything else?
No, one is the cost of a few base metals has increased. That has directly impacted the prices of raw materials like steel and alloy steel. And because of when the war had started in the initial stages in the month of February, March, there was a spike in LNG prices as well. And this has also trickle down to increasing cost of gases that we use in construction. And of course, the recent prices, as you can see, the crude price has been up and down, and there is also an increase in diesel price over the last 2 months, which we use predominantly in our mining projects. So majorly it's these three.
Got it, sir. And last one.
We have PVC clauses that compensate for most of these increases, but these PVC clauses sometimes kick in a quarter later when the indices get updated. Sometimes, if it's a private client, we usually try to approach immediately, and most of the increase has been factored in. Part of the increase has been factored in.
Got it, sir. And for FY27 at Concall level, what revenue are we looking at? And second part to this, for O&M in this 1Q, it was little lower, only 413 crores. If I look at quarterly run rates for the last few quarters, it was little higher. So any specific reason, or it's just a quarterly impact?
No, can you repeat the question at the second part?
Yeah, so for second part, in this first quarter of FY27, O&M revenue was only 413 crores. And if I look at last few quarters, it was little higher than this levels. So any specific reason, or just a quarterly impact, quarterly phenomenon?
Actually, last year we have done some one-time special jobs of overhauling of the power plant. So their revenue is the highest side during the last quarter and previous year. And one-time jobs even this year also will get as and when we get, we will achieve that number. But this is the, as of now, the projected number is based on my existing order basis.
Yeah, and
got it, sir.
A few R&M projects, renovation modernization projects of a few plants that a few IPPs have purchased. We were also getting revenues from those plants around last year, and those we have already commissioned. They have been, and for some of those we have already got O&M contracts. So there is on account of that, there is a slight decrease also in revenue. And overall guidance for FY27 is 7,300 crores, and we are on track to achieving that.
Great, sir. All the very best.
And if you look at the overall year-on-year basis, we are targeting around 28% growth in O&M. Last year it was around 1760, and this year we are targeting around 2089. So quarter-on-quarter there is a variation, but at the end of the year we will get that growth of more plus 20% plus only we will get that revenue growth.
Thank you, sir. Looking for that figure.
Thank you. Next question comes from the line of Abhinav Mandowara with Equitas Investments. Please go ahead.
Hey, hi. My first question was regarding the cost increase. We have seen increasing cost of gases, diesel and base metals. So are our contracts to pass through or variable in nature or fixed price contracts?
Abhinav, can you repeat? Your voice was muffled. Can you repeat the question?
Sorry.
Yeah, I'll repeat my question again. So my question was whether our contracts are variable or fixed price contract. As we can see, there has been increase in the cost such as gases, diesel and base metals, and it has impacted our margin.
Yes, sir. So most of the contracts have PVC clauses factored in, so they are variable contracts. But sometimes it doesn't compensate to the extent of the market price increase because they take some time to update the index. But in such cases, especially with private clients, we take up with the client and see whatever is not factored or protected as per the formula. Any erroneous increases, sometimes clients pay back. So in most cases, the clients are paying back.
No, actually, to add on to what he said, basically most of the contracts cover with the price variation clause during the contract period and extent period, and there is an element of what is called fixed cost compensation over on cost. That also there is a fixed amount. But what happens is when the major portion of the work is done after the contract period, the problem arises. And in that case, we have to resort to claims management. And of course, in the very unforeseen circumstances, we can also invoke the arbitration and dispute resolution mechanisms. That is an exception case. Generally, we try to settle it. And as Rohit said, private customers, they try to settle it and pay across whatever is there reasonable. Or they will try to do in a business way that future jobs will take it and then it gets some sort of understanding on that. But in the public sector, there are rules for them, and therefore they have to go by that. And then, as a last resort, we have to resort to dispute resolution, putting a proper claim. When we find the additional costs have exceeded our own whatever our costs we are incurring.
Okay.
Hi, this is Riya this side. I just wanted to understand for a stable in nature, how much these bigger contracts, how is the kind of receivable for these bigger contracts like Adani and BPCL, and what is the amount of orders which are pending from these two entities specifically?
Yeah, you will have to repeat the question.
Slowly.
Your voice was, we couldn't quite get what you said.
Hello, am I audible?
Yeah, you're audible. Yes, now it's better.
Yeah. Just wanted to understand what is the order backlog from Adani, NTPC and PHEL, these being the larger customers. And my second question is in terms of receivables. What is the nature of receivables we are seeing? Since our order size is increasing, is there any change in payment cycle, or what is the newer payment cycle for the current customers?
Yeah, what I can say on this, on the BHS side, we have got a broad classification. On the installation side, we got a backlog of 1586 crores. On the civil and power sector, 4,282 crores. On the O&M side, which is mostly in the private sector, that is about 3,500 crores. On the balance of plant, what we are doing with the BHL, that is about 2,675 crores. And specific backlogs are there, railway 783 crores, electrical balance work 684 crores. And then, the other sectors like, roads and then drinking water, about 900 crores, 1,000 crores, sorry. Then, like that, we have got a breakup of the backlogs available, pending workers to be completed.
Then, in Adani, we are having outstanding of around 2,400 crore orders worth, total orders worth of pending. 14 orders we are executing right now. And in BHL side, around 5,300 is five major projects which we are executing. So these two are the major. NTPC, we are not having much of exposure, and Vedanta, we have another private player. We are executing 6 projects with Vedanta, which is around 1551 crore of order of backlog is there.
Got it. And the Adani 2,400 is over how many years, and also for BHL?
The order timelines, you are asking about the order execution timelines. So generally, it will be typical ranges from 2 to 3 years between them. O&M generally they will give typically 3 to 5 years, and the construction civil and all 2 to 3 years between. So you can take all our closing order book. You can take 2.5 years is the execution period. You can take average period.
Got it. And in terms of receivable days, what is our current cycle of payment, and are we seeing any delay from these bigger, larger players, or do we have any different terms?
No, generally Adani and other private players, after submission of bill, they take another 15 to 30 days. Initially, they will give 70% payment on submission of the bill, and after that, before month end, they will pay the balance 30%. In the case of BHL, their period is 30 days from after we submission of the bill to them.
No, most of the contracts is within 30 days. After the certified bills are hatched, and then the payment is due.
Got it. And is there any amount kept for retention?
Sorry?
Any retention money?
Retention generally 5% general retention money is there. As per the agreement clauses, we are submitting bank guarantee and we are collecting the money along with the running bill. There is no deduction. They are deducting, but they are releasing the money against the bank guarantee.
Got it. For this last question, for the current year is guided for around 0.5% margin, and considering around 20-21% for it, what will be the non-MDO margin like? Are we seeing a dip in that?
On MDO margin.
See, the MDO margin will be 15%, but that component is only 5 to 6% at this point of time. With the overall turnover, the remaining 95% if you take the standalone average, you can take 10%, 11% range of, including blended with O&M business, around 12 to 13% will be there in the standalone level business.
Got it. I think that would be helpful. I'll join back the queue for further questions. Thanks.
Thank you. Next question comes from the line of Suhas Naik with Creda Capital. Please go ahead.
Hi, thank you. Can you share your view on the O&M business, how it's likely to scale up in the next 2 to 3 years? And what kind of margins we enjoy in this business at operating level?
Yeah, I think O&M continues to drive the business and top line as well as the bottom line. And we have seen it has compounds about 30% of our overall business. And the major push for the O&M continues to be the capacity additions, as I said earlier, which is going to happen in the next 5 to 6 years at the rate of 8 to 10,000 megawatts. And there, the importance of the O&M is from the private sector for outsourcing and whatever plants are getting commissioned. Suppose there is a plan for Adani to complete more than 20,000 megawatts, then JSW has got plans. And then Vedanta is having plans. Therefore, these plans will definitely come up for O&M business, that is long-term outsourcing. And the opportunity size will be about 800 crores per annum. And then that depends how much is the outsourcing is done. And we expect most of the projects in the private sector commission will come for outsourcing. And the public sector is a question of how they take as a policy matter. But recently what we have seen is that about 5 plants we are working on O&M, long-term O&M. That is an indication that public sector also will be interested to add on to the O&M profile to see that their plants are better managed with better margins and outsourcing than in-house management. And we expect more opportunities in the public sector also. Therefore, the growth will be there. What we have seen, the growth will continue to be there in the O&M side in the coming 5 to 6 years.
And what about margins? What kind of margins do we enjoy in this business?
Yeah, around what we are having 18 to 20%.
That's good. Great. And one more question is about our execution capacity, both human capital as well as balance sheet. How much of orders we can execute on yearly basis based on our current strength, both of manpower and balance sheet? Yeah,
one is the financial capacity and the working capital management. I will bring out the physical capacities. The organization is having a huge HR base, trained base with about 4,000 engineers and then about 45 to 50,000 workforce. That is a basic strength. And another important aspect is the 2 aspects of project this one, management and construction management. We have got very specialized groups in each of the segments, and they also take up the adequate plans and requisite inputs planning required for doing the new projects. That way, in fact, the organization's capacity to enhance the resources is quite substantial. Last about 1 year back, we had about 40,000 headcount. Today, it has gone up to 50,000 based on the requirement of the manpower in the increased O&M business and also some of the new installation jobs which has come up in the private sector of the power also. And another matching important capacity requirement is in terms of handling equipment, construction equipment in civil, mechanical, cranes, and then all the civil area of the equipment. That continuously we are updating. We are providing capital budget for that, for new add-on capacities. That way, and then we have only exception cases where the capacities are very high, craneages like 500 ton capacity or 700 ton capacity, we resort to hiring. Otherwise, 80 to 90% is managed with in-house capacities.
In addition to the sir, what he said, the working capital requirement, basically 30% of our revenue is coming from the O&M business where there is no material involvement and equipment requirement. So the 1 month salary is only the money required for this maintaining these employees. So the 70% of the business, our EPC business, we recently entered, and earlier we used to do majority of them are in the construction contracts through LCs and all. We manage the materials and. So with the present level of working capital limits, with the present staff, we can do up to 10,000 crore of revenue. Only thing we need to add every year 120 crore of capex for the requirement, new orders requirement.
Great. One last question is about the trajectory of operating margin. What we are talking about is we are getting into BPOs more, balance of plant more. Then we're talking about MDOs, and the third is the O&M. All these businesses will have a higher margin. So over at the company level, do we expect the margin profile to improve as we go into 28 and 29?
Yeah, because it depends on the mix of your O&M and mining business. Your year on year, your EBITDA margin will go up. So we are targeting around 0.5% jump in every year and till 2030, and after 2030 it will touch almost 14% of EBITDA margin from the present 12.5%, 12.25%.
Thank you, sir. Thanks for the response. Thank you.
Thank you. Next question comes from the line of Dhananjay with Centrum Broking, Mumbai. Please go.
Yeah, thanks for the opportunity. So in this quarter, the ETC business has, in terms of revenue, it has come down from 250 crore to 217 crore, and also we didn't have any order inflow in this segment. So how do you see overall revenue in this segment? Because last year we had a very strong growth. On annual basis we did about 1,300 crore from ETC segment. So how do you see this segment to do this in current quarter, looking at order pipeline?
The major, sir, under the segment, we used to do the Athena Vedanta project and FGD projects. Because of the accident happened at Athena project last year, last 3-4 months back. First quarter we have impact of revenue in the Q1. That's now recently they started the work in our work, and that it will be covered in the Q2 onwards. And FGD also we almost completed the major works, and we are nearer to the completion. Maybe in this quarter we'll try to close that entire FGD balance works also. Because of this, comparatively this is lower revenue in the ETC business. And again EPC internally our erection and civil people are internally they are working on the internal in-house EPC business that will come under the EPC turnover of 96 crore once they are engaged with the EPC works also.
So whatever shortfall we'll have here in given Q1 the power plant construction is also partly because of some of the skill has been diverted to doing industrial construction EPC, the BOP EPC project that we have taken up with BHEL. So it's a similar nature of work. So we are using the same skill to execute some amount of work there. So you'll see some growth there, but overall power construction and EPC together, you'll see a good growth. You'll see a growth of 20 to 22% if you club both of them. If it's only power plant construction, erection, testing, commissioning, we believe we have maximized our execution potential. We are able to execute 14 to 15 boilers, 800 megawatt boilers around at the same time. And we plan for this to only increase by 1 or 2 boilers year on year, which will only contribute to a minor increase of 5 to 7% growth here. But on the other hand, EPC is going to grow at 22 to 22%. So an average growth of 14 to 15% is what can be expected from the power sector.
Now, looking at the backlog, if you see the trend previously, in the year 2024-25, we had a backlog of 14,387 crores and we achieved a revenue of 6,000 plus crores. Therefore, today the backlog is 60,228. From that angle, even 40% plus the new orders will come up should give reasonable growth for the current year also.
Mr. Dhananjay, are you done with the questions? Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I now hand the conference over to the management for closing comments.
Yeah, Thanks for your participation and all. I think at the beginning of the quarter we have seen what are the direction which the company has to go. With a diversification into balance of plant, that's a huge growth perspective, and then new opportunities are going to come up there. And then the continued investment in the power sector with add-on capacity of 16 gigawatts in the coming 7 to 8 years, 6 years. We will continue to focus on that, and the resultant O&M opportunities just come up with the new plants will be there. And then the focus on the infrastructure, on railways, and then other sectors that will be stabilized. And then the international business, we are doing pretty well in terms of O&M and maintenance jobs with better margins. And we expect that, the new opportunities coming up in West Africa and then the Middle East and the GCC countries should enable us to grow in the international sector also. And definitely new 2-3 opportunities are being closely worked out with the EPC contractors there. And that will substantially add up to the installation jobs and the service jobs, like what we have done earlier before 2023-24. That will come back on the pipeline once this piece comes into the position there.
Thank you. On behalf of Power Mech Projects Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your line.